My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to save you a little money. My job is not just entertain, but explain how days like today can come and just crush your portfolio. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Now, if a company after company were going bankrupt with massive layoffs, if banks were failing all over the place, if unemployment were rising from 5 to 6%, if you couldn't get a job, yeah, then the Fed should be cutting rates. Right now, we got plentiful business formation. The banks are doing fine. Unemployment rate's still under 4. That's why the Fed decision to stand pat today is so joyously, I think, predictable. Nobody should have been surprised by this, yet the Dow lost 317 points, S&P plunged 1.6%, and the Nasdaq plummeted 2.23%. People fool themselves into a level of unjustified euphoria about everything, including the Fed, and it is time to take a breath and accept that in the year 2024, stocks can indeed go down. Now, I like to goof around on a site called DraftKings, it's a betting thing. You can do so in two ways. You can gamble on the games, or you can do what's known as daily fantasy, where you put in a lineup using a mythical $50,000. That second option, daily fantasy, is exactly like picking a stock portfolio. I mean, exactly. You have to put players in or you just can't win. You just like with stocks, okay? You have to figure out which stocks are the best and which are what you're willing to pay for or overpay for, a la the Super Six-Pack. You might want to take a flyer, and Nucor or GM probably doesn't cost you much money, but the point is you can't make any money unless you have a portfolio. On days like today, you have a lot of straight-out gamblers who bet only on the direction of the market. They do not interest me. They don't invest in companies. As a matter of fact, I find their thinking pedestrian. They're possessed by what the Fed has to say within the confines of a very strong economy that doesn't have a lot of stress and could at any minute get overheated again. We're on a soft landing path here, people, one where you barely even know the plane's hitting the ground. That's exactly what you want. There's really only one thing that could spoil it: if the Fed cuts rates too quickly. And then we get some hot inflation numbers that cause Jay Powell to lose his credibility. Good thing he took the notion of a March rate cut off the table. That was always a sucker's bet. As I told you repeatedly, we need 6 straight months of good numbers like we've had to make me comfortable that inflation's truly calmed down, and we don't have that many numbers yet. Now, here's what matters for you. You may not know it, but you're most likely not doing that big bet on the game. You're much more like daily fantasy role players than in the straightforward bets on a given contest. Yet most of the people who come on our air, they live in a different universe from you. They're making these monstrous bets, not only on whether the Fed will cut or when, but they even try to guess what month it is. Notice I use the word guess. Their game is not your game. They actually are playing a game. You're investing. Money managers make these bets because if they don't drive short-term outperformance, their investors pull their money out. You do not have that problem, thank heavens. Frankly, I think today's Fed action and selling aftermath makes it so that we can go back and start deciding what stocks we should pick up after the rubble. Daily reality investing, if you will. And what do we see? I see two markets that came into the earnings season one way too hot, and the other one hasn't done anything. With this background of the Fed doing nothing, you got to err on the side of picking players that haven't run too much. Because anything that's run too much can slip down, even on good numbers. Case in point, Alphabet. Really reported a terrific quarter. We did some, by the way, if you want to check these companies, we did some great analysis in the Investing Club. And one thing I can tell you is this was a fantastic quarter. It's a return to growth for the all-important Google Cloud business, which is what we were worried about. I say, doesn't matter, though. Day after day for weeks now, analysts have been whispering tremendous things about the quarter to come. I have no idea how they got those projections, how they raised expectations so much. Why did they do it? Stupidity, showmanship? I do not know. Either way, we now need to get rid of all the daily fantasy, what I call streamers in Alphabet, and look for lower levels to do some buying. Microsoft gave you fantastic cloud numbers. Don't listen to what people said. They just looked at the stock down. They said, oh, it must be bad. Great artificial intelligence figures, good gaming results, incredible color and Copilot, and above all, a juggernaut of combined power that makes me think, wow, so happy you're in such a big position for the Chapel Trust. But when you have a stock like Microsoft that's played by everyone in daily fantasy, nobody's going to make any money. Stock ran so much that you just weren't getting good odds. You got to now look for a better entry point. Keep your powder dry there. Then there's AMD. We had CEO Lisa Su on this morning on Squawk on the Street, and she showed off first graphics cards that truly are competitive with NVIDIA's best stuff. Although, given that NVIDIA makes more than just the chips, they make the software inside, you can argue that NVIDIA's chips and NVIDIA's stock are a better buy. Still, AMD says artificial intelligence cards will be about $1.5 billion higher in sales than we thought. More important, Sue believes the total addressable market for these kinds of products could be worth roughly $400 billion by 2027. Keep that number in mind, because that prediction was viewed as outrageous. An incredulous group of analysts seem stunned that she used this $400 billion number. I think some of them considered it hubris, others just considered it to be inaccurate. Me? I met Lisa Su when she just took over AMD and the stock was trading at $5. She correctly told me to get off the Intel bus and onto the AMD train. Intel was about 35, 7 times higher. A greyhound. I watched the stock of AMD levitate, and at $8, changed my ways, swore off Intelaholicism, and got on board the little engine that could. I've been a believer ever since, and I'd be a buyer right into the sell-off right now, the 160s. By contrast, what actually worked, at least for most of the day, let's take a stock like Starbucks. This stock started breaking down in the middle of November, right when Israel's war against Hamas became full-blown, and Starbucks got hit by pro-Palestinian protesters, even though there's no connection here, called collateral damage. Protests had their intended consequences. A good number of occasional customers stayed away, even as Starbucks is a publicly traded, non-Jewish owned or run company with no ties to Israel. Misguided. At the same time, China, teetering for months on end, really went off the rails. I mean, like, yeah. With same-store sales coming in at 10%, we were hoping for 17%. That's bad news. Good news. Stock came into the print way down from its highs, with people like me telling Investing Club members that it would miss because of both the protests in China. When Starbucks missed because of the protests in China, the stock had nowhere to go but up. That's where it stayed until Jay Powell, playing the big game, chose not to spike the ball and declare victory in the end zone, lest it be considered a fumble and a touchback, and he hurts his hand on the Jenkins' hot seat. Well, that was last week's game. Starbucks may be a steal in daily fantasy and actually a reality. A couple of bucks stand here? I think so. Look, I'm not trying to minimize the Fed's actions, nor am I trying to be glib or make fun of what we do by using a DraftKings analogy. Remember what I do at Mad Money. I'm trying to use any metaphor I can to try to keep you informed and interested and not clueless and baffled like so many other people who really don't give a darn how you do. Long story short, the hot stocks got too expensive to put them nothing but them in your lineup. The sleepers are winning and represent good bargains. Bottom line, the game is self-correcting. The too hot eventually cool down. The sleepers wake up and get too expensive themselves. It's a process, people, and if you approach it clinically, you'll know these expensive stocks can come at a price that can and will diminish as the underlying companies can't keep up with Wall Street's overhyped expectations. Feel free to blame the analysts who spent the last month raising price targets on everything hot based on absolutely nothing. They, not the companies, caused the now unfolding reality, not fantasy problems, in your portfolio. John in Virginia. John.
Yeah. Hey, Jim. First of all, many thanks to you and Jeff Marks and your wonderful staff for your invaluable insights and the confidence that you give retail investors like me.
Thank you, John. Jeff Marks. We were working. I don't know if you guys, we were cranking it out last night at 11:30 and then getting up at 3. Thank heavens for Celsius and my internist, Dr. Pepper. How can I help?
Okay. Well, you may remember that Truist Financial Corporation is the product of a 2019 merger between BB&T and SunTrust. And so this company based in Charlotte operates in the growing Mid-Atlantic and Southeast and offers, a full plate of retail and commercial banking products and insurance products, among other things. And it's really strong, apparently. It's got a common equity tier 1 capital of about, I think it's over 10%. So it's very strong, and it seems well-positioned to take advantage of its market.
John, I like it. It's got a 5.6% yield. It's a conservative bank. It's well-run. It's the type of thing that, frankly, if we were playing daily fantasy, I'd say I'm going to slot that right in the flex position, and it would do very, very well. Hey, you know what? Why don't we go to Khalid in Georgia? Khalid.
Yeah, hey, Jim. Thanks for taking my call. I'm calling about Sofi. Sofi became gap positive.
Look, this is crazy. All right, look, Sofi delivered a quarter. It was a terrific quarter. I don't know why these analysts hate it so much. They took it and they went, they just like, boom. I mean, it was unbelievable what they did to it, and I can't believe it. I think it was an insult to the people who own Sofi, also including Anthony Noto, who's the CEO. Stock shouldn't be down here. All right, look, long story short, the hot stocks got too expensive to put nothing but them in your lineup. The sleepers are winning. The sleepers will eventually wake up and they'll get too expensive, and then we'll cycle back to the ones hot. Mad tonight, going up. I'm seeing if that's where the stock of elevator manufacturer Otis could be headed when I talk to the company CEO. Then all aboard the rails. All aboard. I'm digging into the cohort to see if investors could expect a rail rally sometime soon. And boy, some of these look really attractive. And then Thermo Fisher, TMO, fell today on disappointing outlook. So are investors looking at the buy the dip situation, or should they steer clear? I'm leaning toward the former. But we'll ask the questions and we'll see what we think. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.